In each of our countries, I do want to underline that, we gear our policy decisions to our domestic monetary policy mandates. And in Canada, we have our own currency, we have a flexible exchange rate, so we can run our own monetary policy. So simply put, we don't have to do what the Fed does. We can do what Canada needs. I do think, though, we're looking at the same things and asking ourselves the same questions. I think we both need to feel confident that we're clearly back on a path to 2% before it would be appropriate to reduce interest rates. Last week in Canada, we held our policy rate at 5%, where it's been since last summer. We did stress that we are encouraged by the recent progress we've seen on inflation, and we want to see it sustained. And just this morning, Statistics Canada published the March CPI. As expected, headline inflation came in close to 3%. We have seen gas prices in both our countries move up. Importantly, though, measures of core inflation did tick down again, and that does suggest that underlying inflationary pressures are continuing to ease. So we continue to be moving in the right direction. The other thing I want to underline is that in the conduct of monetary policy, we do spend a lot of time looking and understanding what is going on in the United States. U.S. economy has a very big impact on the Canadian economy. We also watch the U.S. economy closely, particularly through the extraordinary period we've all been through in the last few years, because the more we understand what we have in common and our differences, the better we can learn from each other's experience. And let me just close on a few words on just how integrated the Canadian-U.S. economy is. And Randy, you highlighted some of the key facts. I would totally share your perspective. I think the economic relationship really is the model for mutually beneficial open trade and investment. 77% of Canadian exports flow to the United States. And as you underlined, what less people know is that Canada is the United States' biggest export market. 17%, or as you said, almost 20% of U.S. goods head north to Canada. If you look at foreign direct investment, there is a similar two-way dynamic. In 2022, more than half of Canadian FDI went to the United States by far the largest share of our FDI. That was roughly $43 billion. In the same year, $50 billion of U.S. FDI came to Canada. So it's a pretty balanced relationship. And I think what these numbers underline is just how close that economic relationship is and how it works in both directions. And the final thing I'll say is, when you look forward, we face many of the same structural challenges. Our labor forces are aging. There's going to be a big challenge with new technology, training, and making sure we have the skilled workers our economies needs. Climate change is affecting both our economies. We're both grappling with shifting trade and investment patterns globally. Supply chains across both our countries need to build more resilience. Conflicts internationally are increasing global uncertainty. And for all these reasons, I am very glad we're having this discussion. We do have much in common. And Randy, as you underlined, when we work together, we can get a lot more done.
The performance of the U.S. economy over the past year has really been quite strong. We had growth of more than 3% last year as rebounding supply supported both robust growth and in spending and also employment, alongside a considerable decline in inflation. The more recent data show solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal. So I'll say a little bit about our two mandate goals, maximum employment and price stability. As I mentioned, the labor market remains very strong. Payroll job gains have been strong over the first quarter, averaging just a tick above 275,000 per month. The unemployment rate has been below 4% for 26 consecutive months, which hasn't happened in more than a half a century, the longest streak of its kind. Strong demand for workers has been met by a substantial increase in the workforce due both to rising labor force participation and a substantial increase in immigration, as indeed Canada has experienced as well. So even with this strength, by many measures, our labor market has been moving into better balance over the past year. The ratio of job openings to unemployed workers was extremely elevated in 2021 and 22, has now moved back down to levels just above the pre-pandemic era. Surveys of workers and businesses indicate a normalizing labor market. So do the rates of both quits and hires. And broader wage pressures also continue to moderate, albeit gradually. So the overall picture for the labor market is one of real strength, but gradual normalization. Turning to price stability, our inflation mandate. Inflation, of course, declined quite significantly over the second half of last year, over the whole year, but particularly in the second half. But 12-month core PCE inflation, which is one of the most important things we look at, is estimated to have been little changed in March over February at 2.8%, and the 3- and 6-month measures of inflation are actually above that level. So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. We took that cautious approach and sought that greater confidence so as not to overreact to the string of low inflation readings that we had in the second half of last year. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed. At the same time, we have significant space to ease should the labor market unexpectedly weaken. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us.